what we're thinking about every day is how we invest on behalf of our clients. And I think the whole active versus passive debate is actually a false dichotomy. We've talked about this before. The reality is today, every decision you make as an investor is an active decision. The decision to buy an index is an active decision. Which index you buy is an active decision. The decision to seek alpha through a different strategy is an active decision. So what we're doing each and every day is thinking about how we combine strategies and how we can generate outcomes for our clients.
Is anything non-correlated? What's your best thing for non-correlated? Right?
Bitcoin.
Yeah, that was correlated though. Everything, the air came out of the market and the air came right out of
100%.
Well, I think it's an age-old answer, which is the right answer, which is you have to diversify. You have to diversify, and I think today increasingly what we're thinking about is 3 dimensions of diversification. 2 traditional dimensions, which is diversifying across geographies, diversifying across asset classes, but increasingly we think you have to start diversifying across strategies. So if you're going to be in equities, you have to think about using index, you have to think about using factors, you have to think about using systematic or quantitative strategies, and you have to think about good old-fashioned fundamental investing. All of those things combined together will create the best outcome on a risk-adjusted basis.
If I were a yield-seeking senior that living on income, I'm giving up again. I thought my day had come. You know, I thought finally.
Make money in the bond market or in
you still have no yield, do you? It's never coming back. It's ever.
Look, we're in, I think, a low interest rate environment for an extended period of time. And so I think that's why it's tough for investors and it's tough for our clients. And what we're doing is trying to find ways to help them through diversification, through different strategies to deliver the return that they need, whether it's an individual in a 401k or a multi-$100 billion pension plan. It's kind of the same problem. And we're seeing our clients diversifying more into privates, more into alternatives, more into systematic strategies. And I think they have to do all of those things today if they're going to try and protect themselves in this low rate environment.
Do some of those alternatives get a little risky, though? I mean, if you're talking about things like in privates or issues along the way, I mean, that would be my concern with that. I don't know.
Yeah, you always have to balance risk, right? So if anybody thinks there's only one side of the coin, they're wrong.
Yeah.
So there is no free lunch. Right. And if you want to have a return-seeking strategy, you have to understand the risks that you're taking beside.
So you look at like the CLO market right now. You want to be in that market?
Well, I think that you might want to be in that market as part of an overall diversified strategy. Probably not, probably not that senior who is living on a fixed income. That's probably not the right strategy for him or her. But it might be part of a diversified strategy for a large diversified fund.
I mean, we've had people who have come in here and said that you should have 1% of your holdings in Bitcoin. Nobody said that lately, but we used to have people telling us that. And I thought that was crazy for the average retail investor sitting at home. I mean, I guess if you've got money to burn and you're a wealthy individual, that's one thing.
Look, I think for the average retail investor, you're a single individual, and you have to think very, very differently about how you construct your portfolio than, for example, if you're running a pension fund. Now, we have both of those types of clients at BlackRock, and we think the strategies that they require are very different. And think about it: if you're sitting in a pension plan that's maybe, tens of thousands or hundreds of thousands or millions and decades to think about it, then your approach to those issues is very different.
I would just think that the converse of not getting any yield means, by definition, that equities are probably going to perform better just from discounted value. So you need to keep more assets. You need to be permanently heavier weighted in equity. I guess if you need diversity, you need to go around the world with equity exposure.
I think by and large that's right, but you have to understand you're taking additional risk and additional volatility.
Well, then what do I do?
Well,
how do I minimize the risk then? Cash?
Well, first of all, you come to BlackRock and you ask us.
Well, that's the first thing I would do. But
absolutely.
Yeah. Larry told me to do that. Yeah.
But look. The answer is you have to work harder. The way you construct your portfolio is that much more important. And if you are in equities, you have to think about things like dividend yield on your equities. There's a lot of stocks out there today that are actually generating very nice dividend yields, and we expect that to continue.
Can you write some calls for me, do some buy rights or something like that, or you won't do that for me?
Well, we won't do that for you, but we might help you construct a portfolio that would include it.
Okay. All right. One of the things about putting together an entire portfolio is that portion of the portfolio that absorbs some of the volatility and the downside, which would normally be either corporates or munis or governments, but you can't do 1 and 2 year stuff. And I don't want to do 10-year because I think
Because you're going to be dead? Why not?
Maybe.
Why not? Why are you? But why?
Because I don't. It's just that
why you thinking?
I don't. I'm
That's a
still
mistake.
locked into the idea that yields are lower than they should be, or that lower than they are historically. So I've still got that mindset. So you think? I mean, I can't. But who buys a German book?
But you've got to be thinking. You've got to be thinking. The bottom line is you've got to be thinking longer.
Would you buy a 10-year German?
European insurance companies that have to.
Yep.
And you've got to be thinking longer term. And this is a huge mistake that investors are making,
Right.
and they're continuing to make in this market
So
environment.
that's the way to do it. You put a percentage in really low yielding.
Not necessarily, because the longer term you think, the more volatility you can actually absorb in the short term. So if I was 25 years old today and had 40 years of
I
income,
do all stocks. I do zero.
Me too.
in bonds.
Correct. And so if you're at that age and you're thinking long term, and I think as longevity increases for individuals, they have to be thinking the same way. But you should never be thinking about 2 to 3 years in terms of how you manage your
If you
portfolio.
look at what just happened in December, then is that a huge opportunity because prices just came down so substantially?
I think we are seeing a change in the structure of the market. I think the fourth quarter represented the change, and I think active strategies are going to pay off much more than they have in a period of time we've had the last 5 to 7 years, where everything's been driven by what the Fed, the BOJ, the ECB does. Today, there's an opportunity for active management to really make a difference. Individual security selection and being more prudent in the way that we construct portfolios.
Where'd you grow